Hello, today is Wednesday, February 16th, 2022. Wanted to give you a quick mortgage interest rate update for what's been going on with rates since the start of the year. What you're looking at right now is basically a chart of bonds, mortgage bonds actually, that trade on the bond market every day. And ironically, mortgage rates actually come from the movement of these bonds. It's really that simple. Now, a red day, a red candlestick is bad for mortgage rates, meaning rates are going up, and a green candlestick would mean that rates are coming down, which is what we want to see. Unfortunately, if you look at this line that I drew from the beginning of the year all the way to today, you see a sharp sell-off in the bond market, more specifically mortgage bonds. And of course, that equates to a sharp increase in mortgage rates. I mean, rates probably are up a full 1 point from the end of last year. Now, what's causing that? Well, there's a couple of things, but the biggest thing is inflation. And inflation is basically the kryptonite to the bond market. So if there is inflation, which we know there is, or perceived inflation, usually the bond market doesn't like that too much, and bonds will sell off, and as they sell off, yield or rate will go up. And that's basically what you've been seeing, very high inflation readings so far. And now there are other factors. We're watching this Russia-Ukraine situation pretty close, because negativity actually helps mortgage rates. So we don't want this to happen, but if Russia were to attack Ukraine, usually there's a flight to safety in the stock market because there's fear. And when money leaves the stock market, it usually goes into the bond market. And in some cases, mortgages are purchased in the bond market, and that will help drive prices up and give us more of a green candlestick. And that will help mortgage rates come down. Now, assuming that Russia does not attack Ukraine, then we're really back to watching inflation right now and seeing where that's going to peak out. And more importantly, we have to watch what the Federal Reserve does. All right, the Fed's going to step in aggressively this year, starting in March, and they're going to probably hike what's called the short-term benchmark interest rate, or the Fed funds rate. Okay. Now, you need to know that the Fed funds rate is not a long-term rate. All right, it is not a 30-year fixed rate. And oftentimes, when we hear that the Fed's going to hike rates, we panic because we think that mortgage rates are going to go up with them. Now, not all the time, but in many cases, the Fed is increasing rates to fight inflation. Okay, and when they're doing that to fight inflation, that actually could help mortgage rates because, as I said, inflation is the kryptonite to the bond market, and rates don't like inflation, and they will rise if inflation is rising. So if the Federal Reserve starts to hike interest rates to get in front of inflation, bond market might like that, and it could start to rally. And if it starts to rally, that means rates could, come down a little bit, or possibly stop going up any further, which would be a nice thing to have happen. Now, there are other things going on that can get really economic-y, if that's a word. But we're going to keep it real simple today and say that right now we see that we did bounce off of this floor here. You can see a green candlestick yesterday and today, and we're going to hope that we can continue to go sideways here, or maybe improve a little bit and get some of this big loss back, because rates don't usually tend to go in the same direction all the time. We have pockets where they go up and down, but the general pattern right now so far for the start of 2022 is rising rates. All right, now let's put this into perspective real quick. So if we're in the fours, all right, that only means that we're back to pre-COVID interest rates, not the end of the world. All right, in the 80s, rates were at 18%. All right, and most recently, over the last 10 years, they've been historically low. So there's nothing wrong with the mortgage rate in the fours. Yes, I agree. It's not the upper twos or the threes anymore, but it's not 8, 9, 10%, or even 18% either. So you have to put things into perspective and realize that we're still at historic lows. And if rates do stay in the fours, it should not affect your purchasing power or buying power. And in some cases, a refinance may still make sense as well. So that is your update for this week, and I will be back next week with another update. Have a great day.